Hey guys, how you doing? I've got a short video today on affordability. How can a lender sort out whether you can afford a home loan or not, and what are the types of things that they look at? So let's go through them. To my mind, there's about three key things that go into this. The first is your job and income. Now this is a bit of a no-brainer, right? So what do you do for a job? How stable have you been in that job? And what sort of income figures are you earning out of it? Is it a blue-collar income, a professional income? Is it more casual? Are there gaps in that? So we need to look at what the background is being there, but basically, if in the here and now, you're in a stable income which can be expected to be relied on in the future, that is a good thing. And of course, you look at the amount of that as evidenced by the pay slips. So that's kind of the first thing, the job and the income. The second is the monthly surplus. So here it's abbreviated to the UMI, or the uncommitted monthly income. So when at the end of the month, how much money do you have left over after covering all your expenses? And this could be the current mortgages that you have in place at the moment, or if you're renting, how much is your rent, how much is your housekeeping costs, like your groceries, your power bills, your kids' costs, etc. So the lenders will have a fee, like a base level that they've got in mind for a family of your size, whether you're a single or a couple or more. They'll have a base level, but basically you need to think through your expenses. Think about what's going to go on here and what's going to discontinue. So for instance, your rent will discontinue, but your whole expenses pile will have a certain profile in it based on your life stage. So the second factor is the surplus, or the uncommitted monthly income. As part of this, we'll also be looking at how much of the income that you earn from your job will be going into paying off the mortgage, and that's called the debt servicing ratio. And you don't want to be in mortgage stress. So if you're paying above 40 or 50% of your overall net pay pack into your mortgage there, you'll be experiencing mortgage stress, because basically it's too high and too much of a burden on you. So there will be a level there, and it's generally above 40% of your net that you don't want to be chucking into your main mortgage there, because it could bring you into some stress. Now the last thing is the affordability is also assessed based on interest rates, right? So if interest rates are 3% or 5%, the lender, regardless of where the prevailing current rate is, will add on like a stress test rate. So there's usually 2 to 3% that they actually put on top of that current rate, and they use that as a stress test rate. And through this they say, well, if rates did go up to this degree, would this client still be able to keep their head above water and keep making good on that loan? So the third thing is the assessment rate, or basically what I like to call the stress test rate. So they're the key things that go into assessing the affordability of a mortgage for a client. So when we do an application, we work with a client, we take all those things into consideration, so that we know when we take the application formally through to the lender that it has a definite shot of being approved. So we use the lender's calculators across all the lenders that we deal with. We have access to the exact ones. And when we can make it work in the calculator, that's when we know that the lender will approve that. And these are the types of things that are inputted into that calculator. So we know the lenders that are more flexible, others that are more rigid, and we can find the best solution for our customers. So hopefully this video has been helpful and shared with you a few insights. So keep tuned for some more vids. Cheers.